A warm welcome to you, children. Ending Unit 6. Today we are ending Unit 6. Actually, we are done with all the content of the lesson. But as I always say, it's accounting. And accounting is done with practice. Practice makes you perfect. We are going to practice some double entry accounts and how transactions are recorded in double entry accounts. Like it or not? Like it or not, you have to be fluent, you have to be experts in recording transactions in double entry accounts. Right? As you know, children, 60%, more than 60% of your exam paper is accounting. Right? And accounting depends the accounting records, and as we move on further, the trial balances, the financial statements, everything depends on a correct, error-free recording of double entries. Yeah? Well, you get what I'm saying, right? Get the idea. Correctly recording the transactions is the result, is the main point, is the main factor in creating a good result, the final result. The financial statements, creating them, preparing them accurately. So, recording transactions. Here we go. Let's read out this. Till I prepare myself, can you read out the question? Children? Or you're going to read with me? Alright, no problem. You are required to enter the following transactions in the double entry records of Kendrick Products for the month of January 2011. Yeah, Kendrick Products. That is a business which must be producing some sort of products. Alright. And they have provided us with this information, the transactions for the month of January 2011. Okay. First transaction. 2011, 1st of January. Started the business with 20,000 in cash. Started the business with 20,000 in cash. Who's investing money to the business? Owner. Owner invests money to the business, right? And owner's money is considered as capital. Think of the dual impact of this transaction. Dual impact. What is increasing and what is decreasing? Or what is increasing and the other thing also can be increasing. The dual impact. Or else one thing could decrease, at the same time the other also could decrease. Dual impact. Increasing, decreasing. Think of it. Well, as we can clearly see, 20,000 cash coming into the business. So cash asset increases. Cash asset increases. Assets increase means always debit. Alright, and the money comes from the owner, which means the equity increases. Capital increases. And capital increases means always credited. Alright, debit in the left, credit in the right. Debit left, credit right. Let's draw our accounts, I'm going to draw two accounts. One here. First, as I always say, First I'm going to draw the T format. Then I'm going to divide the columns. Narrow, wide, narrow. Narrow, wide, narrow, wide. Narrow, wide, narrow, wide. All right. Another account. Narrow, wide, narrow, wide. Narrow, wide, narrow, wide. Right, we have two accounts. You want to put the headings? Tell me the headings. First of all, we'll put debit and credit. Debit on the left, credit on the right. Debit left, credit right. Debit left, credit right. Name the columns, children. Date. Debit side, okay. Credit side, date. Details, rupees, value column. You know the narrow column is for ledger folio, right? It's not actually relevant to us. We don't fill the ledger folio column. It's, let's say, out of the syllabus, but it has a use. But in your O-level days, you are not learning that. This narrow column is for ledger folio. This narrow column, I'm talking about this column, okay? Both sides we have the ledger folio columns, but we don't fill them. Next account, we'll fill out the columns: date, details, rupees. Date, details, value rupees. All right. Now tell me, in which account should it be debited? What am I talking about? I'm talking about the first transaction. Started business with 20,000 in cash. We already discussed that cash increasing, cash increases. Or you can use that easy method. Cash coming into the business, 20,000 coming in, and ins are always debited. Ins are always debited. Cash asset increasing, and cash account should be debited. This should be the cash account, or that should be the cash account. We'll make this account the cash account. All right, because there can be more entries going into this account, cash. So in the cash account, I'm going to put the 20,000 in the debit side. There you go, debit side. Value column, I have put 20,000. Date. What's the date? Date is 20th. No, 1st January. 1st January. Date is 1st January. Let's fill out the date also. 1st January. 1st January. So then, what should be the detail or description? What should be the description? What should come here? We agreed, and we have already done this earlier. We agreed that the description of this account, I mean the cash account description, should be the name of this account, the second account, or the other account. Okay? Did you get the idea? The description of this account should be the name of this account. So then, first of all, you have to decide what is the name of this account. Which account is this? Right? Debited in the cash account, all right. Okay, we learned that. And we agreed upon that. This is the debit account. But which account should be the credit account? Let's go and see the transaction again. Read it again. Started business with 20,000 in cash. Who brings in money to start the business? Owner. And we already recorded the cash increasement or the increasing of cash in the debit side of the cash account. What is the dual impact, children? Cash increases. We have done that. Cash increasing. It's already recorded. What is the other component? Decreasing or increasing. Cash increases. At the same time, what is that? Yes, capital increases because the owner's money comes into the business. So then, cash account done. It's done. This account should be capital, that's right. This account should be capital. Okie dokie, capital account, credit side, 20,000. Just like this. Now this. Debit entry and credit entry. Then name of this account, capital, should be here as the description of cash account. As the description of the cash account. And cash should be here as the description of the capital account. Exchanging the names, children. Nothing odd. Nothing complex. Just exchanging the names. Oh, cash. Cash. All right. You want me to show it to you? Okay, I'll show it to you. This name comes here. And this name comes here. Now, is that so hard to understand? No. I'll keep the arrows so it's understandable to you even later. Let's go to the next transaction. Bought goods on credit from T. Peters, 2,543. Bought goods on credit from T. Peters, 2,543. Buying goods is a purchase. Just a few minutes ago, I was explaining everything with my all actions and all. I was telling you that buying goods to the business should be considered as a purchase. all right, and should be recorded in not the goods account. No, should be recorded in the purchases account. Should be recorded in the purchases account. So goods come in, ins are always debited. Ins are debited. Bought goods on credit. And ins are debited. Then we know which account to debit. Purchases account. Drawing the T first, then narrow column, wide column, narrow column, narrow column, wide column, narrow column. Okay, this should be the purchases account that we know. Purchases account. Okay. And debit side, don't forget to mark debit and credit. Credit side, DR for debit, CR for credit. And we are entering the amount now in the debit side, because goods come into the business 2,543. Goods come into the business. Should go to the debit side. 2,543. 2,543. In which account should it be credited? Let's go and see. Bought goods. So goods coming in to the business. Goods coming into the business. Okay. More and more goods are purchased. More stock for the business. Goods coming into the business. But cash doesn't go out. See, you should notice that. Cash doesn't go out because we don't pay cash. Cash doesn't go out because we don't pay. It is on credit. It is on credit, children. Okay. That creates a liability. Who's the liability? The creditor. We owe that supplier because we bought goods from him, didn't pay. Didn't pay. That supplier is a creditor of our business. We are owing him. And it is a liability. Isn't it? Yeah. In that case, children, a liability which was not in the business before increased because of this transaction. 2,543 of a liability increased. At the same time, the goods increased. Liability also increased. 2,543. Liability increased, you know, credit. Is that right now? Is that right? Liability increased, credit? Of course. Liability increased, credit. Another account for the liability of creditor. Another account for the liability of creditors. Narrow column, wide column, narrow column, wide. Narrow column, wide column, narrow column, wide. Okay. Liability of creditor. What is the name of that creditor? Let's see. T. Peters. So we can put the name creditor T. Peters. T. Peters. Debit, credit. Debit, credit. All right. Creditor T. Peters account should be credited, yeah? 2,543. This amount which was debited, now it is credited. Okay, double entries, credited, debited. Description, putting the description. This name goes here. This name goes here. Crossing the names. Okie dokie. That's it. Creditor should be written here. Purchaser should be written here. Right. Put the dates and it's done. What is the date? 2nd January 2011. Yeah, 2nd January. So we put the date here, 2nd January, 2nd first. And here too, don't forget the dates, 2nd January. Is that clear, children? No worries, right? Simple double entries entered in accounts. Okay, we'll do a few more and you will do the rest. Agreed? Third transaction. Put rupees 1,800 or 18,000. That is 18,000. Put rupees 18,000 cash into a bank account. Okay. Taking cash from the business. Taking cash from the business till. Now the till. The cash till. Cash machine. Right? The cash till. From that you take 18,000. Take that money out from the business. Put that money to a bank account. So what is out? What is going out? Outs are credit, right? Cash is going out, so cash is credited. Alright. Cash is credited. Where is the cash account, children? Is this the cash? No. No. Where is the cash? That is the cash account. You don't draw a separate account for cash. The cash account is already drawn. You're recording that. This is a question which is frequently asked. Most of the children ask this question. Sir, we have drawn a cash account, sir, and we have recorded one entry. And this transaction also we need a cash account, sir. We'll draw it here. No, don't draw it again. Don't draw it again. Why do you need to draw it again? It is already drawn. Okay. For each component, for the same component, you don't draw two accounts. You extend the account down, down, down if you need more space, but don't draw a new account. And in this case, it is a credit entry, right? Cash going out. So in the credit side, 18,000. 18,000. 18,000 cash into the bank. Although cash is going out, although cash is going out, a bank account comes into the business. We didn't have a bank account before and now we have opened a bank account, so it is an asset account. New bank account coming into the business. Ins are debit. Which component is debited now? Bank. Do we have a bank account, children? Do we have a bank account? No, I don't think so. No, we don't have a bank account, no. Do we? No, 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 no bank account. Then you should draw a bank account. narrow, wide, narrow, wide, narrow, wide, narrow, wide. And that account should be named as the bank account. Blue. Bank account. Cash account we recorded in the credit side. This entry, I'm talking about this entry. Cash account, credit side, yeah. And it should be debited to the bank account. Not to forget, marking the debit and credit sides should not be forgotten, yeah. Rupees. 18,000 should come to the debit side. And descriptions, children, descriptions. Bank account, this name should go there. Yeah. Okay. And that name should be here. Cash. And the date, 3rd of January. 3rd of. Let's use the same color. 3rd of January. This is the dividing, the center line. The dividing line. In every account, make sure that you draw the dividing line clearly. Alright. Another transaction done. Any more? You have any, complex transactions, difficult ones? Let's see. We are done with this. We are done with that. We have another one here. Bought goods on credit from J. Lee. That is exactly the same as this transaction. Bought goods on credit from T. Peters. Okay, so we have done something like this before. Similar to this transaction we have done. Bought goods on credit from J. Lee. It's like bought goods on credit from T. Peters. Same thing. Tell me the double entry now. Buying goods means goods increase. More and more and more and more goods come into the business, right? So goods coming in, ins are always debited. Yeah, debited. So which account should be debited? Goods account? Goods account. No. For the third time I'm telling you, no goods account, children. It should be the purchases account. Purchases account debited, and because the goods were bought on credit, this is a creditor, and creditors are liabilities, which means the goods account should be debited and creditors account should be credited. No goods account again. Remember, these are the points that most of the time you get confused with. No goods account. Instead of the goods account, purchases account debited, creditors account credited. That's right. Next transaction we have bought goods 592 and paid by check. Sold goods. Let's take this one. Let's take this one. Sold goods on credit to P. Layman, rupees 210. Instead of the goods account, when we purchased goods, right, when goods came into the business, instead of the goods account, we prepared the purchasers account. Now it's not purchasing, now it's selling. The goods we purchased, we are selling to our customers. Which means, children, selling goods should go to the sales account. Okay? Sold goods, so it should go to the sales account. And since goods are going out, outs are always credited. We need an account called sales account. And it should be credited. Right? Special account, so I'm drawing it with blue color. T format first. Narrow, wide, narrow, narrow, wide, narrow, wide. And this is the cash account. Is it, children, cash account? No, this is the sales account. Sales account. We draw this for selling of goods. Selling of goods, sales account. Okay? And it should be credited. Why? Because outs are always credited. Let's check the amount. Sold goods on credit, 210. Credit 210. Date was 5th first. That means 5th January. Oh no, 16th January. Children, 16th. Not 5th, it's 16th January. First. And how about the description? How about the description here? Any guesses? No? To put the description, children, you should know the other account. What is the other account? Let's see. Sold goods on credit to P. Layman. So we recorded the selling of the goods. And do we get cash from this guy? Cash comes in. If cash comes in, we can put to the cash account. We have a cash account. We can put to the cash account. But cash doesn't come in. It's sold on credit. Goods are sold on credit. Which means this customer did not pay us money. Cash did not come in to the business. That makes him a creditor. That makes him a creditor. No, that makes him a debtor. Good. The people who is owing us, our customers, who buy goods, we sell goods to them, those are debtors. Okay? Selling on credit to them, they become debtors. The people who supply goods to us, we buy goods from our suppliers on credit, they become creditors to us because we are owing them. But here, customers, they are owing us, so they are debtors. Now you know what is the next account we need. We need a debtors account. Do we have? No, we don't have. And This is a different data. For different data, we need different accounts. Let's draw this data's account, shall we? All right, data's account. Narrow, wide, narrow, wide, narrow, wide, narrow, wide. Okay. What is the name of this account? Data. And what is the name of this guy? The data. So all goods on credit to P. Layman. Data's name is Layman, so we'll name this account Layman. Lemon. Alright, data Layman account. Don't forget the debits. Don't forget the debits and credits. Alright children, we are done with this now. Sales account was credited and debtors account should be debited. 210. Now we know what should be the description. What should be the description? This name goes here. And this name comes here. Alright, let's write it down. 210 credit, and this in this debtors account it was debit, and sales account, the sales account name should be the description of debtor account. Debtors account, the debtor's name should be the description of. Okie dokie, that's it. How is that? Satisfied? Still difficult? Still hard to find debits or credits? No, I don't think so. Children, double entry accounts and recording the double entries completed in this manner. Recording double entries are completed in this manner. I hope you understood everything that we did today. We have done a lot. We have a lot of accounts, right? Yeah. In the coming sessions, we will get more exercises and to record more double entries, debits and credits. I hope you understood. I hope you enjoyed the work today. With this, we are finishing Unit 6, recording of double entries and dual impacts of transactions. Let's get together once again with the next session, and we're going to start the next lesson, which is lesson number 7, Prime Entry Books. Hope to see you soon, children. Thanks for being with me today. Good luck. See you soon.